Welcome to the first episode of the Integrity365 Financial Insights Podcast. In these sessions, our team of advisors are going to be sharing thoughts and insights into current events of the financial world to give you some things to consider within your own financial planning arrangements. You can follow along with this series on our website, on YouTube, and on streaming platforms. At this time of year, our thoughts are always on end of tax year planning, which encompasses a lot more than some people think. So in this episode, we hope to give you some areas to think of for your tax year end health check and insights into what we have been helping our clients with. Hosting today's podcast is myself, Sophie Haslehurst. I'm a chartered financial planner specialising in tax-efficient investments, and I'm joined by my colleague and founding financial advisor from Integrity365, Debbie Packer. Welcome, Debbie. So how have you been?
Hi, Sophie. Yeah, busy as ever. I always think each time of the year brings its own sort of challenges and objectives. And when you come back into January, lots of people have New Year's resolutions, health checks in progress, and obviously thoughts turn towards completing tax returns, if not already done, and of course, tax year end planning.
Yeah, so when it comes to those types of conversations, at this time of year in particular, what sort of areas are you covering with your clients?
So what I would say is it's conversations we kind of have throughout the year. It just comes to a little bit of a head in the first quarter of the financial year. So basically what we look at is how clients can make the most of their savings. So we look at obviously the ones that have the biggest tax advantages first. So, pension contributions are definitely high on the agenda, as are ISA contributions. And obviously ISA contributions and pension contributions may be for partners or children as well. So we must remember that obviously there are different allowances for different family members.
Definitely, that's really interesting, and one that I think we can all be aware of. When it comes to those conversations as well, do you find that at this time of year people's minds are a little bit more focused on the end of the tax year, or do you think it's something that sort of is always on people's minds?
I think there's definitely more of a focus. Whenever I have a review meeting with a client, whatever the time of year, we always look and make sure that they've used their most tax efficient allowances. But certainly at the start of the year, between January and April, clients are always thinking about that. However, I think what many clients maybe aren't aware of is they can't really leave it until like the last week of the tax year, because quite often providers have much earlier deadlines. So we like to ensure that our clients have done their planning probably by mid-February, which may sound a little bit early, but it's really important to plan early for those events.
And is there a reason why we have to do that? So you've sort of mentioned that mid-February, whereas the tax year ends not till April. What's the reason behind that?
So a lot of our clients are on wrap platforms or are on within managed portfolio services, and those providers have an earlier cutoff date than the 5th of April. So we like to get our meetings in nice and early and do that planning so they don't miss those deadlines.
Oh, that makes perfect sense, because I think everyone always has that focus of April in mind. So you don't think about the fact that really it needs to be done in February in order to get it all sorted by the end of the tax year. So good reminder there, Debbie. And you touched on allowances. So we sort of talked about ISAs, and you mentioned about sort of for each other, if you're a couple and family and things like that. When it comes to these allowances, how much have clients actually got if they want to save in a tax efficient way?
Oh, yeah, excellent. So a client typically has the maximum allowance of 20,000.
Mm-hmm.
They can also, over the age of 18, do a lifetime ISA. And a lifetime ISA has a lower limit. So it has a limit of 4,000, but is ideal for, maybe those family members who are saving for a first property, because they also get an additional 25% payment from the Treasury. So again, really, really helpful. So that can build that pot up, but of course, only if it's going to be used for either a first time property or for later in life planning and retirement planning. You can also do a junior ISA for any family members that are under the age of 18. They can have a junior ISA, and the limit on that is 9,000. So the key numbers to remember in that is 20,000 as an overall allowance. If clients do have family members or are actually saving for a first property, then 4,000 is inclusive in that 20,000 allowance for a lifetime ISA, or a junior ISA at 9,000.
Oh, that makes a lot of sense. Thank you, Debbie. When it comes to other allowances and other things we should be thinking of, one of the other big questions that I'm always talking to people about, and they're always asking, is pensions and how much they should be paying in, or how much they can pay in. What's your sort of thoughts on tax year end and pensions?
Yeah, so pensions are probably the most tax efficient vehicle for many of our clients. So there's a full annual allowance, which is currently 40,000. That's £40,000 gross. The reason I mention the fact that it's £40,000 gross is that if they are a director or have the means to fund their pension through a business, then it's that gross contribution that is the key number. If they are a person who will be paying it out of personal savings, then it's that number, but net of 20%. So they instantly get a 20% tax allowance. So that's like a 20% saving on that investment. And of course, if they are a higher or additional rate taxpayer, by making that contribution, they then put it on their tax return and then get a further 20 or 25% allowance, making it probably the most tax efficient savings vehicle for themselves. Their limit is actually their UK net relevant earnings. So that may be a little bit less than 40,000 for some clients and some members, but really key is it's that UK net relevant earnings figure that is important. But of course, if they have a pension, but maybe haven't funded in previous years, clients do have the ability to carry forward up to the last 3 tax years allowances. So if they haven't paid anything in for the last 3 years, they could potentially carry forward that 40,000 allowance from previous years and this year's allowance, which they must use first, giving them a potential maximum contribution of 160,000, as long as those UK net relevant earnings allow.
So when it comes to the sort of net UK relevant earnings, Debbie, what does that actually mean? Because I know it's quite confusing for some people, because for instance, property income, you still pay tax on, but that doesn't form part of it, does it?
Correct. Absolutely, Sophie. And that's a confusion that's shared by many. So it's the relevant earnings. I think if everybody kind of has it in their mind that it's earned income and not rental income or savings income or any other form of revenue they may get. Of course, some high earners, so for some of our clients, if they are sort of high net worth and have very high earnings, they also may fall into the trap of having a reduced annual allowance. So while I talk about the annual allowance typically being a maximum of £40,000, for clients that have income in excess of 240,000, of course, then they could be subject to tapering. So they may not have the privilege of such a high allowance. But again, we would be able to help them with that and guide them through it.
This is why I think pensions are the most complicated area that we sort of really deal with as well, isn't it? Because you can see all the pitfalls there potentially could be there.
Absolutely. Yeah. Whoever said pensions were simplified, it's not the case. There's lots, but again, with good planning and with sort of help from advisors like ourselves, then clients should be able to navigate sort of the allowances, and we should hopefully be able to get those in before the tax year end, which is really important.
And one of the things I always mention to clients as well is that you can start a pension from when a child's born.
Yes. And what a great start in life. So if you're a parent or a grandparent or even a great grandparent, what a brilliant way to sort of start that child's savings journey. Absolutely. So there are allowances. So for non-earners, so be that children or be that adults that literally don't have any UK relevant earnings, they still have an allowance of £3,600, of which if they're making a personal contribution, it costs 2,880. So they instantly get that sort of free 20% uplift. And if you imagine, sort of compounding over the years, that can become a sizable sum and really meaningful for clients and certainly children as they grow up.
Oh no, that is really great, Debbie. And I think it's one of the ways as well that sometimes if parents or grandparents, like you said, are worried about children maybe spending money or having access to the money, it's a really nice legacy to start building for them.
Definitely. And of course, that leads really nicely on to gifting as well. So every year, clients that have surplus capital and want to help their children or grandchildren or for other family members, they are permitted to gift. And I know this is something that you do a lot with your clients as well, isn't it, Sophie, in terms of those annual exemptions?
Yes, because it's really easy to forget because it doesn't sound like a lot of money, but it can really add up, can't it? So when it comes to gifting allowances, how much are you allowed to gift each tax year, Debbie?
Okay, so per individual, so if you've got a couple, this is each, you're permitted to gift as a lump sum up to 3,000. Now that's 3,000 in total. So if you're gifting to several people, then of course that's shared. But of course, not to forget, if you haven't made a gift in the last tax year, so we're currently talking about 2020, 2021, they can carry forward that 3,000. So before the 5th of April, they could make a potentially exempt gift of 6,000 for the current tax year, and then after April the 6th they could do another 3,000. So again, meaningful sums if they replicate that. And there are other allowances as well, which we won't get into onto this podcast because I'm sure time will be against us, but there are other sort of exemptions in terms of out of income exemptions, small gifts of £250 to any number of individuals, and also sort of in lieu of marriage or birth of particular family members. So that's definitely something we should cover in future ones.
Yes, and also it's a really nice sort of way that we can sort of try and share the sort of wealth that we might have built with the rest of our family. And Debbie, you mentioned there as well about potentially exempt transfers. So what's the difference between a gifting allowance and sort of just making a gift that's larger than that gifting allowance?
So, so the gifting allowance obviously is the 3,000 per year per person. If you were gifting more than that, potentially exempt transfer is effectively a gift that, if made more than 7 years prior to the person passing away, is a potentially exempt transfer. So if the person makes a gift, lives for 7 years, then it is an exempt transfer. So that 7-year clock starts ticking. The beauty of those exempt gifts and that £3,000 is that they don't have to survive for 7 years. They can make that and it's instantly outside.
That makes sense. And again, it's quite a complex area, isn't it? Because you don't think about it. If you want to give money away, you feel you can give it away. You shouldn't necessarily be dictated to in that way, but it's just a way that we can carefully plan for it, isn't it?
Absolutely. And it all comes down to that legacy planning and just giving things a little bit of foresight, and also recording when gifts are made as well, which is something I found that, a number of people maybe just don't think about. But it's really important because HMRC or Treasury can certainly catch up on estates if they haven't done the planning properly.
Yes, and I think we're all guilty as well. We go into the new year with a resolution and then we sort of think, oh, it doesn't matter, it's absolutely fine, but actually it does, doesn't it?
Absolutely. And while we're on the topic of exemptions, because it's such a hot topic at the moment, the other sort of allowance that a lot of people think about as we approach the tax year end is sort of capital gains. Capital gains can come from a lot of different sources. So, whether it's a sale of shares, whether it's a sale of a second home, sale of a business, there are lots of places that can generate a capital gain, and therefore it's assessable against somebody's capital gains tax allowance. And as we reach the end of the tax year, I think it's something that, I certainly remind a lot of my clients about. But Sophie, I know that is changing as well.
That's right. So when Jeremy Hunt announced his new budget in the autumn, he thought that, one of the ways he would try and recoup some of that tax was by reducing the capital gains tax allowance. So the reason that's really important is because you've only got until the end of this tax year in order to benefit from the capital gains tax allowance at the higher amount. So the capital gains tax allowance is the amount that you can realise before you have to pay capital gains tax. And the reason that it's good if you have an allowance is because it means you can still realise gains without actually having to pay any capital gains tax. So for this tax year, so that's 22-23, the capital gains tax allowance is 12,300. But what they announced in the budget was that this is now going to reduce. So from 23-24, that's going to reduce to 6,000. And then from 24 to 25, it's going to reduce to 3,000. So sort of that's quite a significant decrease. So 25% of what the allowance is now. This is a conversation sort of a lot of clients seem to be aware of, Debbie, and I don't know if you're having that as well, but it sort of seems to be really relevant to people because it makes them think about, oh, should I be using the allowance this tax year if I can?
Absolutely. So it's a conversation that I have with many clients during the course of a normal tax year. And we always try to use up sort of all allowances that we have available to us. The other option as well that clients have is obviously they can, between a husband and wife, for example, they can maybe transfer assets before they're ultimately sold and realised. So you've got, if it's a couple, they can use two allowances effectively to sort of get rid of a gain and not have such a tax burden. But you're right, at the moment, and particularly this year, it's even more key that we try and establish and realise as many gains up to those allowances as possible, because we are aware that, next year the allowance is halving, and then the following year it's halving again, which is a massive shift. So yeah, definitely worth having hard on the radar.
And talking about sort of moving money between spouses and things like that, it's worth clarifying as well that that is between spouses, isn't it? Not just long-term partners and things like that. But I think people forget about that.
Yeah, absolutely. And I mean, as I say, having a financial advisor and somebody go through that planning just to make sure that, as a client, you're aware of everything and aware of those allowances and those changes in advance is really important. So it just ensures that when a decision is made, it's made considering all of those boundaries and all of those points. So the amount of tax that can be saved on a transaction by just doing things in a certain order, or maybe if you are realizing gains, doing them over 2 tax years, or maybe even 3, rather than just doing it all in one go if it isn't needed at that point in time. Again, that's where portfolio planning comes in. It may be a little trickier with property, but again, we do have tax advisors on hand as well, or that we can refer to if there is a complex estate, or if it is sort of property and estate planning that's needed as well. So we will cover that in future podcasts as well in a little bit more detail.
So that's a really great point about estate planning in general, Debbie. Do you feel that people should be thinking about that at this time of year? Is it just that everyone's minds are focused on tax because end of January is self-assessments and the end of the tax year is fast approaching in April?
Yeah, I think literally whenever I speak to clients, they will always have the most topical tax agenda. So whether that's finishing a tax return, paying one that's due, obviously, as we get towards the end of January, and also obviously planning for things for this tax year. But it's really important that they look at every tax angle. So estate planning is key, and changing ownership and sort of making sure that assets are owned in the right way can absolutely save a lot of problems and a lot of tax further on down the road. And of course, not forgetting when that autumn budget was announced by Rishi in earlier this year, then one of the other things that changed or was announced, they were fixing the allowances until 2026. That's now been pushed down the road, and now those allowances are fixed until 2028. So whilst on paper, it was almost like, we're not putting up the taxes. It was almost by keeping them level, and with the effects of inflation and obviously portfolios building and assets growing, hopefully in value, obviously that is generating a lot more tax because the allowances aren't keeping in pace with that inflation or those increases in value.
That's so true, because inflation has been the topic of 2022, I think, don't you?
Definitely, yes, for many reasons, yes.
Fantastic. So our takeaways from today are that we should never leave our tax year-end planning until the last minute. It should be something we're doing throughout the year. But if, like many people, now's the time of year where you're sort of sitting down and giving yourself that space we need to get sorted by sort of February time in order to make sure that you can sort of go through all the processes that you're supposed to, and that we make the most of our allowances.
Absolutely. And just on that, our Insights newsletter, our quarterly newsletter, which is out in January, has several articles covering just that. So there's a really interesting one on end of tax year health check that was done by our colleague Marcus Rayer. There's also a really interesting one covering all of those ISA allowances we talked about a few moments ago, that's in the newsletter, covered by Douglas Sims. And I know you've done a really interesting piece, Sophie, on VCT and AS. So again, I think a very hot topic for another podcast.
Definitely. And also, just some general information as well. So one of the things that I thought was really brilliant in our newsletter was the fact that we talk about our centralized investment proposition and what we're doing, because markets have been challenging in 2022. And I think, it's important that we're clear with clients how we're dealing with that.
Oh, definitely. Yeah. And obviously I'm really proud to sit on the investment committee, and we genuinely kick the tires of every fund and every investment management house we have on our panel. So all very tried and tested. They're all there for a reason. We've done complete due diligence on all of the providers, and obviously not fearful to make any changes should we need to. So the investment committee there is to basically make sure that our process is very streamlined, but also should give our clients a huge amount of comfort, that we are absolutely looking under the bonnet and ensuring those fund managers are doing a great job and are sort of in keeping with their benchmarks and doing what they should do to make our clients' funds go that little bit further.
Very important, Debbie. Thank you. So I think that wraps up today's podcast. Thank you so much for listening. And Debbie, thank you for joining me. It's been really lovely to sort of talk through all these things that, are really important as we sort of launch fully into 2023. If you would like to listen to future episodes, these will be shared on Integrity365's YouTube channel, our website and streaming platforms in the very near future. If you've got any questions for our advisors, either to answer personally about your own financial planning needs or to talk about in a future episode, please don't hesitate to get in touch using the details in the description. We also have linked some really helpful guides for further information on the topics we discussed today.